Subscribe to LearnCab and hit the bell icon to get notified.
Hello friends, welcome to the amendment lecture of GST as applicable for CA final for May 2022 examinations. Friends, all the amendments from 1st of May 2021 till 31st of October 2021 as available in the statutory update of ICI are going to be discussed over here. I wish you a very happy learning. Few general guidelines before we start up. Friends, for LearnCab students, the lectures are already updated in the portal. However, I would recommend you to watch this amendment lecture series at one shot either in the portal or in the YouTube so that you get a grip over all the amendments which are made. Amendment notes are attached. You can download them and have a look for quick reference. Approach. Friends, we are only going to discuss about the change aspect. So therefore, I would be presuming that you are already aware of the basics. Even though we would be discussing the background which led to this change, but still I would be going with the presumption that the basics you are already aware of so that you are able to appreciate the change in a much better manner. Friends, books. Those who wanted to order the books, they could visit this website. The books which are available is Study Revise Crack. It is a detailed module covering the entire syllabus. Then you have Question Bank, which is named as Train Your Brain, a comprehensive question bank covering all the models of questions. And you have a book called as QR Infographics, which is nothing but just summary charts for quick conceptual revision. So if you want to place order, you can visit this website and place your order. Amendment in ITC 04. Now friends, according to section 19, a principal can send the goods to a job worker, be it inputs, be it capital goods. He can send the goods to a job worker without payment of taxes. However, he needs to file a return. He needs to file a return called as ITC 04. ITC 04 contains the details of goods sent by the principal to the job worker and also the goods which are received back by the principal from the job worker. According to rule number 45, prior to amendment, ITC 04 happened to be a quarterly return. ITC 04 happened to be a quarterly return. The due date was 25th of the month following the end of the quarter. Post amendment, ITC 04, the frequency and the due date of ITC 04 depends on the turnover of the principal. So the revised due dates and the revised frequency is as follows. If the aggregate turnover of the principal in the preceding financial year, if it was up to rupees 5 crores, then ITC 04 is an annual return. It just needs to be filed once in a financial year. Throughout the financial year, all the goods which were sent by the principal to the job worker and also the goods were received back by the principal from the job worker. For throughout the financial year, one ITC 04 needs to be filed. And what is the due date? The due date is 25th of April following the end of the financial year. Say for example, for financial year 21-22, the due date for ITC 04 would be 25th of April 2022. Now, if the turnover of the principal in the preceding financial year exceeds 5 crore rupees, then ITC 04 is a half yearly return. So for April to September, there is going to be one ITC 04. For October to March, there is going to be another ITC 04. What is going to be the due dates? The due dates for ITC 04 April to September. Say for example, for financial year 21-22. So from April 2021 till September 2021. The due date for this half yearly ITC 04 is going to be 25th of October 2021. Similarly, for October 2021 to March 2022, for this portion of the financial year, for this half yearly ITC 04, the due date happens to be 25th of April 2022. So friends, the changes prior to amendment, ITC 04 used to be a quarterly return. Post amendment, ITC 04 depends, the frequency and the due date depends on the turnover of the principal, If the aggregate turnover of the principal in the preceding financial year, if it was up to 5 crore rupees, then it is an annual return. Due date is 25th of April following the end of the financial year. If the turnover of the principal happens to be more than 5 crore rupees, if it is exceeding 5 crore rupees, it is a half yearly ITC 04. The due date happens to be for the first half 25th of October. For the second half, it happens to be 25th of April. Amendment in 48 sub rule 4, a class of notified registered persons. Friends, according to 48 sub rule 4, a class of registered persons would be in a position to issue a tax invoice only after obtaining an invoice reference number, only after obtaining an invoice reference number from the common portal. This invoice reference number needs to be embedded in a QR code, and this QR code needs to be present in the tax invoice as a content of tax invoice according to rule number 46. So now friends, who are those class of registered persons who are notified for the purpose of e-invoicing under 48 sub rule 4? Those persons who are required to obtain invoice reference number from the portal. Who are those class of registered persons who have been notified? That notification was there in 13/2020. 13/2020 notified those class of registered persons for the purpose of e-invoicing provisions 48 sub rule 4. It simply told you that all those registered persons whose aggregate turnover in any preceding financial year from 17-18 onwards, if it exceeded 50 crore rupees, the provisions of 48 sub rule 4 would be applicable, and it would be applicable for B2B supplies and also for exports. However, prior to amendment 13/2020 excluded two categories of persons. So which means for these two category of persons who are excluded from 13/2020, e-invoicing provisions would not be applicable. Who were those two persons? One, it was a special economic zone unit, not a special economic zone developer. Mind you, the wordings were very clear, special economic zone unit. And the next one was those persons who are referred in 54 sub rule 2, 3, 4 and 4A. Those persons who have got some specific relaxation, specific points as far as contents of tax invoice was concerned. There were those persons, that is insurer, banking company, supplier of passenger transportation services, GTA and multiplex screens. So these two persons were excluded from e-invoicing provisions. Now there is an amendment to this list. There is a third category of person. There is a third person who has been included, which is government department and local authority. So therefore friends, e-invoicing provisions are not applicable. E-invoicing provisions are not applicable to government department and local authority. So as to say, if there is a government department, if there is a local authority who is making supplies, and even if their aggregate turnover in any of the preceding financial year from 17-18 onwards, even if it has exceeded 50 crore rupees, they need not obtain an invoice reference number from the common portal. For the government department and local authority, 48 sub rule 4, e-invoicing provisions are not applicable. So this list of 2 now gets increased to list of 3 by inclusion of government department and local authority. For them, 48 sub rule 4 provisions are not applicable. A few changes in the manner in which authentication of return filing, authentication of applications which is being filed on the common portal is being done. Now friends, as we all know, all the applications and all the return filing which is being done, it is electronic. It needs to be done through the common portal. Manual applications, manual return filings are not allowed. So since now the applications and return filings are electronic, it also needs to be signed. It also needs to be verified electronically. So authentication of those filings which is being done also needs to be electronic mode. So friends, what were the various electronic modes which are available? The applications which are being filed, the returns which were being filed could be authenticated by 2 modes. One, it was through digital signature. 2, it was through OTPs. Now OTPs could be Aadhaar based OTPs, and OTP will be going to the mobile number which is registered in the Aadhaar database, or it could be OTP being sent to the registered mail ID and registered mobile numbers of the authorized signatory as per the information which is available in the common portal. So it could be through digital signatures, it could be through OTPs. Now friends, as far as companies were concerned, for them, the manner of authentication of applications, be it refund application, registration application or any other application, or be it return filing, the manner which was allowed was only through digital signature. For them, OTP based authentication was not allowed. However friends, due to work from home during COVID scenario, in such a case, it was mandatory. It became mandatory for the government to allow authentication through OTP as well, because digital signature could be in office, whereas returns and other applications are being filed remotely from a place other than office. So therefore friends, for time being, for certain period of time, OTP based authentication was extended to companies as well. However, the relief which was extended was only temporarily. Now this temporary relief has been made permanent. Rule number 26 has been amended to state that all applications which are being filed on the common portal, be it registration, be it return filing, be it refund application, be it any other application which is filed on the common portal, all persons including companies can authenticate that said application, the said return filing through OTP as well. So friends, the restriction which was there that the companies can validate their forms, the companies can validate their applications only through digital signature has now been removed. Even though the companies can now authenticate, can validate their returns, their applications through OTPs. Now friends, amendment in 35 subsection 5. There was a section called as 35 subsection 5 which has been omitted. Now friends, as we all know, returns under GST, there are periodical returns under GST. The periodical returns, we have GSTR 1, we have GSTR 3B, we have GSTR 4, and there are various periodical returns. And also there are other returns under GST. Now other returns, an example could be annual return, which is nothing but a summation of all the periodical returns which are being filed. Audit under 35 subsection 5. Friends, 35 subsection 5 has been omitted. Now what was 35 subsection 5? 35 subsection 5 stated that all those registered persons whose aggregate turnover exceeded a threshold, they need to get their accounts audited by a chartered accountant or by a cost accountant, and they need to file a reconciliation statement in form GSTR 9C along with the annual return which is going to be filed under section 44. So what is that reconciliation statement? This reconciliation statement would reconcile the value which is furnished in the GST returns vis-a-vis the value which is available in the audited annual accounts. Now friends, what was the threshold? As we discussed, all those registered persons whose aggregate turnover exceeded a threshold needs to carry out an audit, needs to get audit done under 35 subsection 5. So friends, what was the threshold? The threshold, it was referred in rule number 80. The threshold was initially kept as 2 crore rupees. Later on, for the financial year 17-18, 18-19 and 19-20, they increased this threshold from 2 crore rupees to 5 crore rupees. So friends, in essence, the situation was all those registered persons whose aggregate turnover exceeded 5 crore rupees should have filed along with GSTR 9 the annual return. They should have also filed GSTR 9C, which was a reconciliation statement which was to be certified by the professionals, chartered accountants or by the cost accountants. So now friends, this particular issue was highlighted to the government as though it is a cost intensive exercise. The value addition which is coming out of this GSTR 9C is not worth the cost which is involved. It is the revenue collections which are there. It is not worth as compared to the cost which was involved by getting the work of GSTR 9C being done by these professionals. So therefore, the matter was not put up in the appropriate manner in which it should have been presented. So therefore, the government has decided to omit 35 subsection 5. So now friends, the position is something like this. Along with GSTR 9 annual return which is going to be filed under section 44, there is still a reconciliation statement GSTR 9C which needs to be filed, which needs to be furnished. It is still applicable for those persons whose aggregate turnover has exceeded 5 crore rupees. But now this reconciliation statement which is there, it has to be self-certified. Certification need not be obtained for a professional. The registered person can self-certify this GSTR 9C and he can upload it. This 35 subsection 5 has been omitted. So friends, rule section 44 which speaks about annual return, that also has been replaced. Rule 80 also has been amended. So friends, 35 subsection 5, the omission, we'll just have a look at it. Every registered person whose turnover during the financial year exceeds the prescribed limit shall get his accounts audited by a chartered accountant or a cost accountant and shall submit a copy of audited annual accounts, the reconciliation statement under 44 subsection 2 and such other documents in such form and manner as may be prescribed. So this now goes away with, so you do not have to furnish a reconciliation statement which is certified by a professional. Self-certified reconciliation statement would be sufficient. Provided, the proviso, provided that nothing contained in this subsection shall apply to any department of central government, state government, local authority whose books of account are subject to audit by Comptroller and Auditor General of India, or an auditor who is appointed for auditing the accounts of local authorities under any law for time being in force. So friends, in short, for the departments of the government and the local authorities, for them, even when 35 subsection 5 was in force, reconciliation statement was not required to be furnished. All that they required was to file GSTR 9 annual return under section 44. Now friends, this 35 subsection 5, this proviso, since 35 subsection 5 itself has been omitted, since 35 subsection 5 itself has been omitted, this proviso has been taken care of in section 44. This proviso has been taken care of in section 44. Now friends, what is the difference? The difference is prior to amendment. Prior to amendment, these departments, for them it was sufficient to file GSTR 9. GSTR 9C is not required to be filed. What is the effect after amendment? Friends, after amendment, GSTR 9 itself is not required to be filed. I repeat, prior to amendment, these departments should have filed 9. 9C was not required. After amendment, as we are now going to see section 44 in detail. Friends, the amendment, what we have discussed is only so much. Since section 44 has been replaced totally, we are just going to read section 44 in a detailed manner. When we are going to read section 44 in a detailed manner, you will get to know that prior to amendment, these persons, that is these departments, were supposed to file 9. 9C was not required because this proviso is there in 35 subsection 5. After amendment, this proviso is now placed in section 44 of annual return itself, which means that these persons are not required to file GSTR 9 as well. So friends, we are now going to have a look in detailed manner of section 44, which has been substituted. We also are parallelly going to look into rule number 80, which speaks about the threshold which is there in section 44. We have seen that the returns are electronic. The returns needs to be filed through the common portal or through a facilitation center which is being notified. Returns cannot be furnished manually. Similarly, friends, all the returns which are being furnished, rather not only a matter of returns, any application which is being given, any return which is being filed, that needs to be verified, that needs to be authenticated electronically. So what is the means of authenticating the return which you are filing or the application which you are making? You have the various means. The various means are, you can authenticate those returns or applications through a digital signature. You can authenticate it through an Aadhaar based OTP. If you select this option of Aadhaar based OTP, an OTP will be going to the mobile number which is registered in the Aadhaar number of the authorized person. To that particular mobile number, an OTP will be going, that mobile number which is registered in the Aadhaar database. And once that OTP is being entered, the return or the application which is being filed would be treated as authenticated. Another one is electronic verification code to the mobile number and the mail ID of the authorized signatory as per the records which is available in the GST portal. To this authorized signatory's mobile number and mail ID, an OTP would be going. Once this OTP is being entered, it would be treated that this particular return or this particular application is authenticated. So these are the various modes through which the application or the return which are filed electronically are authenticated electronically. Now that we have seen section 47, let's have a look at section 128 and then let us decide, is there any reduction which is possible in the late fees which we have just seen under section 47. Let's have a look at section 128. The government may by notification waive in part or in full any penalty in 122, 123, 125, currently not bothered about it, or any late fees referred to in section 47 for such class of taxpayers and under such mitigating circumstances as may be specified therein on the recommendations of council. So friends, what we understand is the government has got powers under section 128 that it can issue the notifications and bring down the late fee which is being imposed under section 47. Now friends, let's have a look. What are those notifications under which are being issued under section 128 and under which late fees has been reduced? We need not remember the notification number. So therefore, we are just saying that these are the notifications which are issued under section 128. So the first one is reduced late fee for GSTR 1 and GSTR 3B. The details of outward supplies which is given under section 37 and 3B is a return which is filed under section 39. So friends, here max late fee has been specified. That means the capping is being done. If it is a nil return means where the tax payable either through credit ledger or through cash ledger is nil. So wherever the tax payable is nil, the maximum late fee which can be demanded is capped at rupees 250 per return. And friends, please understand, this 250 is under CGST. Parallelly, you would be having the same 250 under SGST. If it is not a nil return, then you need to find out according to the class of the SSC. If the aggregate turnover in the preceding financial year was up to 1.5 crores, then the max late fee which can be collected, this is the maximum late fee which can be collected, is rupees 1000 per return. Of course, under CGST, parallelly would be having the same amount under SGST. If the turnover is more than 1.5 crore but up to 5 crores, then the capping is being done at rupees 2500 per return for CGST. If the turnover is more than 5 crores, there is no reduction which is given under section 128. Whatever is the normal late fee which is there under section 47, it would continue. And if you remember, over there the capping was at rupees 5000 per return. Of course, under CGST, parallel you would be having the same amount under SGST. So friends, this is the capping which is being done by the notifications which is being issued under section 128. Friends, please understand, they are not reducing the late fees. They are saying they're not reducing the late fees which is calculated on a daily basis. They're saying whatever is the late fees which is under section 47, the maximum late fees will not be exceeding these amounts which are specified in the notification. Let's take few examples to understand it better. Let's say aggregate turnover of this particular registered person in the preceding financial year was 1 crore rupees. He files the return with a delay of 40 days. Assuming if it is a nil return, what would be the late fee which is payable? If it is not a nil return, what would be the late fee which is payable? First, let's write down what is the actual late fees which is coming according to section 47. Then we would be writing down the late fees which is there under section 128, and then let's give the final answer so that we are able to understand and appreciate the provisions in a better manner. So friends, if you could recollect section 47, the late fee was rupees 100 per day subject to a maximum of rupees 5000. And friends, please understand, all the examples which we are discussing and which we are going to discuss, we are only going to write according to CGST law. Whatever answer you are getting, the same answer would be under SGST law, and the total answer would be a summation of CGST plus SGST. So here we go. Under section 47, you did not have any bifurcation of nil return or other than nil return. It was very simple, rupees 100 per day subject to a maximum of rupees 5000. So friends, there again, there was no bifurcation of nil return and other than nil return. Also, there was no bifurcation between the turnover of the SSC. It was a flat fee, rupees 100 per day subject to a maximum of rupees 5000. So let's write down according to section 47. If the delay was for 40 days, it is 4000 or 5000, whichever is lower. So I have 4000. Section 47 capped the limit of late fee at rupees 5000. Whether it is nil return or other than nil return, it is still 4000. In case of 60 days, it is 6000 but subject to a maximum of 5000. So therefore, it is going to be 5000. Irrespective of the turnover, irrespective of whether it is a nil return or other than nil return. Going further, if it is 2 days, it is of course 200 subject to a maximum of 5000. So these are the late fees which is being imposed under section 47. Now this, when we are going to read it along with the notification which is issued under section 128, let's check what is the answer which we are getting. Friends, in case of nil return, whether it is being filed by a person irrespective of the turnover, the maximum amount of late fee which can be imposed is rupees 250 per return. So here in case of nil return, it is 4000 versus 250, 5000 versus 250, 200 versus 250. So naturally here, first case the answer is going to be 250, second case the answer is going to be 250, third case the answer is going to be 200 rupees. Third case, the answer is going to be 200 rupees because naturally that is lower than 250 rupees. Similarly, for other than nil return. Now friends, for other than nil return, here we go. The turnover is 1 crore. When the turnover is 1 crore up to 1.5 crores, my capping is at rupees 1000. So 4000 versus 1000, my answer is going to be 1000. My turnover is 4 crores, so I'm fitting into this slab 1.5 to 5 crores. My capping is at 2,500. So my answer is going to be 2,500 rupees. The third case, when my turnover is 7 crore. When a turnover is 7 crore, there is no reduction which is there under section 128. By default, you fit into section 47. Section 47 says rupees 200. So therefore here I don't have an other answer because section 128 gives no reduction for that person whose turnover is beyond 5 crore rupees. So whatever is the answer under section 47, the same answer continues. My answer becomes 200. So these are all the answers under CGST. Similarly, you will get another same answer under SGST, and CGST plus SGST would give you the total answer. So this is the reduced late fees under GSTR 1 and 3B by notification which is issued under section 128. Next, reduced late fee for GSTR 4. If it is a nil return, capping is being done. So this is the maximum late fees which can be imposed under section 47. This is being told by a notification which is being issued under section 128. Maximum late fees could be 250 per return, and in case of other than nil return, it could be rupees 1000 per return. Friends, you need not remember this anything separately. It is as good as the previous table. Friends, in the previous table, it says up to 1.5 crores. The maximum late fees was rupees 1000, and naturally for composition taxable person, his turnover cannot exceed 1.5 crore. The same thing of rupees 1000 per return has been kept over here as well. So same thing you have as it was there in the previous table. You need not remember anything separately for GSTR 4. It is 250 per return and 1000 per return. Let's take examples. Turnover is 1 crore, delay is 40 days. Let's see, according to section 47 for GSTR 4, the late fee was rupees 100 per day subject to a maximum of rupees 5000. Irrespective of whether it is a nil return or other than nil return, irrespective of the turnover. So now friends, in this case, rupees 1 crore, 40 days is the delay. So friends, when 40 days is the delay, it is going to be rupees 4000 or rupees 5000. We are now discussing according to section 47. So it is going to be rupees 4000. When the delay is of 2 days, it is going to be rupees 200. The turnover is 1 crore. Aggregate turnover of the preceding financial year, it says it is 7 crores and delay is 2 days. Now friends, here it is not applicable because at the first instance, a person whose aggregate turnover in the preceding financial year was 7 crore, he would not be in a position to opt for the composition scheme in the current financial year. So we mention it as not applicable. Now friends, under section 47, whether it is a nil return or other than nil return, my late fee remains same. Now I come to section 128 and I see what is the maximum amount of late fee which can be imposed. For nil return, it is 250 per return. So I have 4000 versus 250, 250, 200 versus 250. I get the answer as 200 rupees. So these are the late fees wherein I read section 47 read along with notification which is issued under section 128 for the purpose of a composition taxable person. Next one, if it is other than a nil return. If it is other than a nil return, if my turnover is up to 1.5 crores, because naturally in this case composition taxable person is going to be up to 1.5 crore, it was 1000 per return. So it is 4000 or 1000, 2000 or 1000, I get 1000 as the answer. In the third case, it is not applicable because I am not in a position to opt for composition scheme. I am sure you are able to follow this. Whatever answers we have got, it is under CGST, the same answer is under SGST, and you add these both, you would be getting the total answer. Next one, reduced late fee for GSTR 7. Now friends, if you look into the reduced late fee for GSTR 1, GSTR 3B and GSTR 4, it gave you maximum capping. It gave you maximum capping. It did not touch upon the late fee which is imposed per day. So therefore what you did was you read it along with section 47 late fee, because there it said you rupees 100 per day subject to a maximum of 5000. Under section 128, rupees 100 per day it did not touch upon. That subject to a maximum of 5000, it gave a capping. It gave a capping wherein it told it could be 1000, it could be 2500. Now friends, but if you look into GSTR 7, it is reducing both these aspects. It says 25 per day subject to a maximum of 1000 per return. 25 per day subject to a maximum of 1000 per return. Now friends, in such a scenario, there is no requirement for us to write down the late fees under section 47 because in section 47 it is 100 per day subject to maximum of 5000. Here it is 25 per day subject to a maximum of 1000 per return. In any case, the late fees of section 128 would only be on a lower side. Friends, the point which I am trying to differentiate is 1, 3b and 4. You wrote down 47, you wrote down 128, then you compared the lower. Because there, under 47, it was 100 per day subject to maximum of 5000. Under 128, they did not touch upon 100 per day. That kept on continuing. They only touched upon the maximum limit that they lowered it down. So there was a possibility that rupees 100 per day can come on a lower side, which we have seen in our examples. In few of the cases, it had come. But friends, the reduced late fees for GSTR 7. The reduced late fee for GSTR 7, it is 25 per day subject to a maximum of rupees 1000 per return. So friends, here they are touching upon the late fee per day also and the maximum capping also. So therefore, there is no requirement for me to see under section 47 because that will always be on a higher side, because there it is rupees 100 per day subject to maximum 5000. Here it is 25 per day subject to maximum of 1000. So therefore friends, and also I am not bothered about aggregate turnover of the preceding financial year because here there is no such condition. It simply tells you 25 per day subject to a maximum of 1000. So friends, here it is going to 250 rupees, 2500 when the delay is for 100 day, but this is subject to maximum of rupees 1000 per return. 10 days it is going to be 250, 25 per day into 10. Irrespective of turnover, the answer remains the same. 100 days, irrespective of the turnover, it is going to be 1000 rupees. It would have been 2500, 25 per day, but again it is subject to maximum of 1000. So these are the reduced late fees which are there under section 128. Now friends, let's have a relook again at under section 47. What was the late fee which was prescribed? The late fee which was prescribed for outward supplies under section 37, returns under section 39. Who are the persons who are filing returns under section 39? You have a regular taxable person, composition taxable person, NRTP, that is non-resident taxable person, OIDR, ISD, TDS returns. Then you have a final return under section 45. For these persons, the late fee was rupees 1000 per day, during which such failure continues, subject to a maximum of rupees 5000. For annual return under section 45, you had a late fee at lower of the following: 100 per day, during which such failure continues, or 0.25% of the turnover inside the state or union territory. Now friends, let's revisit at the reduced late fees which was there under section 128. It was for GSTR 1, GSTR 3B, GSTR 4 and GSTR 7. So friends, the point which I am trying to highlight is section 47 listed out late fees for various returns. Section 128, out of those returns, it is reducing the late fees only for a selected returns and not for all returns. So therefore, which are those returns which are not impacted by section 128, which means section 128 does not reduce the late fee of those returns. They are return of an NRTP, that is GSTR 5. There is no reduced late fees under section 128. It continues to be at section 47. OIDR 5A, ISD GSTR 6, final return under section 45, and also annual return under section 44. For these returns, NRTP, those which are marked in yellow, OIDR, ISD, final return and annual return, under section 128, there is no such notification which is there, which is reducing or which is capping the late fee of these returns. For them, it remains under section 47. For the rest of the returns, GSTR 1, GSTR 3B, GSTR 4 and GSTR 7, in these cases, there is a capping which is available under section 128. And even in this case, friends, as far as GSTR 1, 3B and 4 is concerned, you need to combinedly read 47 and 128 to get the correct answer. But however, as far as GSTR 7 is concerned, you just need to apply section 128's capping which is being there, because there it is reducing the per day limit also and also the maximum limit which was specified under section 47. I am sure you are able to follow this.
Subscribe to LearnCab and hit the bell icon to get notified.